Inflation's now 8.5%, as I'm sure you're aware. 8.5%, the way they measure it.
Right.
You measure it in reality, it's the highest rate of inflation we've ever seen by a lot, Lee. Housing, beef costs, energy prices, they're all up miraculously the same amount. The number is 20%, not 8.5%. Trim, mean, don't eat meat, eat grass, hedonically adjusted, substitutionalized adjusted crap. It's 20. And so the Fed has to do something. It's, if you want to measure it accurately, 10 times higher than their asinine inflation target. But the way they measure it, it's more than 4 times their inane inflation target. So they have no choice. This is the most hawkish Fed, at least as we're promised, the most hawkish Fed since Paul Volcker by a lot.
Now, and they made a micro adjustment to the rates, and we've got an inverted yield curve, right?
We have an inverted yield curve. Yield curve inverted. Here's what you want to know about the inverted yield curve. I wrote a whole piece about it. The yield curve inverted after just one lousy, measly 25 basis point rate hike. That's how weak the economy is. It normally takes 300 basis points to invert the yield curve, at least. So it happened every other time. Now it's 25 basis points. And yield curves inverts. And then you're usually only allowed 100 basis points after that. And then the Fed says, oh no, I'm done. But now they can't say that because they'll do 100 basis points between May and June. And then guess what? We can't be done because you'll have a 1.5%, 1.25%, 1.5% Fed funds rate, but inflation is still going to be 8.5%, or maybe comes down to 7.5%. But you still have a huge inflation problem that you just can't ignore. The Fed can't. This is when the Fed's going to stop hiking rates. When the rate of inflation goes down below 4%, or the stock market goes into free fall and the credit markets freeze. Either one, it could be both, but one of those things will happen first. I think that the stock market and credit markets will freeze long before the Fed gets inflation down to 4%.
So if the market crashes, like you suggest, and
I hate to interrupt, but sometimes I have a nasty habit of doing that. First of all, the market already crashed.
Right.
I mean, in early January, half of the NASDAQ stocks were down 50% or more. So the market already crashed. If you own bonds, you're down 16%. If you go out on duration bonds, long-term bonds. You own the NASDAQ Qs, you're down what? I think I wrote it down. QQQ's down 14%, S&P's down 7%. So you're down. It's already crashed. I mean, depends on,
But I mean, it sounds like you're suggesting worse.
Did I say again?
I said it sounds like you're suggesting worse ahead.
Oh, I think it's going to get much worse ahead. Okay. We have, like I said, the most hawkish central bank ever on the planet.
Well, you had suggested that the market has much further to go. I mean,
they haven't even started yet, Lee.
Right.
The Fed raised rates by 25 basis points, and they haven't drained one penny from their $9 trillion balance sheet. So growth is slowing rapidly on a global basis. We've seen the peak of inflation, albeit only going to come down on a rate of change basis, maybe 100 basis points, 200 basis points. It's still going to be way higher than the Fed's target rate. And now the Fed has promised 50 basis point rate hikes and the most daunting quantitative tightening experiment ever. 2 times greater than the one they did before. The only other one, they tried to unwind the balance sheet. They got about $500 billion out, and then the market cratered and the credit markets rose. This time they're going to be doing $1 trillion a year. Let me see if that's going to work. So they're going to try it. They're going to fail. Markets are going to crash. Asset prices are going to plunge. And then we'll see what they do. The Fed put, I'll tell you this, the Fed put is much lower than anybody really feels on Wall Street. I keep on hearing, the Fed's going to come in. The Fed is not going to come in because they're trying to get Democrats elected in the midterm elections. And the Democrats are not going to get elected if inflation is at 8.5%, the way the government records it. It's not going to happen.
Are they going to get elected if the market crashes much further than it is now?
So the calculation is, let's see. more people who own stocks are Republicans than Democrats. So I'll let the stock, I'll sacrifice the stock market so I can get the Democrats to hold power in Congress. The members of the FOMC are mostly liberals, and in my opinion, and who controls the White House right now, and who nominates people to the FOMC? It's the president. Okay, so that's my predicate. I'm not backing away from it. And even though it might not be true, even if and by the way, I'm a libertarian. I hate both parties. I hate Republicans, and I abhor Democrats. So I'm politically unbiased. It's the right thing to do. I mean, what's their choice, Lee? Here's the calculation. I can raise rates 25 basis points. Get worried that the stock market isn't going up in the first. Oh, we had a whole quarter where it was down. Oh, okay. Let's not drain the balance sheet at all, and let's not raise rates anymore. What do you think is going to happen when the 10-year note goes to 15%, double digits? Because that's where it'll go, and mortgage rates go to double digits. What do you think is going to happen to asset prices anyway? And then you have two problems on your hand. You have asset prices to crater because there is no alternative. There's a great alternative, and it's called sovereign debt at double digits. I'd probably put if you can offer me 12% on a 10-year note
you're there, no doubt.
I'd sell every damn thing I own and more. And you know what? Or they let that happen, and then they have the market crash. Oh, by the way, they have a really bad inflation problem that's much worse than they have now. Or they can crash the market and not have an inflation problem. What do you think they're going to do?
Right. Yeah. I mean, the inflation problem is just hitting everyone, and it hits the lower classes the most. I mean, it's the biggest percentage of their earnings. So, I mean, especially when they go to the gas pump or the supermarket. So as to that, I know you're calling for like a deacceleration of inflation in the near future. Disinflation. Okay, so in that scenario, I could see equities, I could see the real estate market deflating, but what about everyday things like commodity-driven things like food and energy?
Well, I think commodities would. Well, hopefully oil prices would go down a little bit, but not much. I mean, I don't think they're going to go down much at all, to be honest with you. If you look at used car prices, they might have peaked. If the Fed crashes, is able to at least bring home prices into a more tractable scenario, where they're not rising 20%, they're rising at maybe 10% a year. I think at the very minimum they're going to be able to do that. I think home prices are going down 20% year over year this time next year. So